So when we speak about the business investment, this is an investment whereby a person could either buy shares in an existing business or start their own business. So these types of investments are three. Number one is Johannesburg Security Exchange or Stock Exchange. Number two, it's unit trust. Number three, it's government retail bonds. So in this first part, I'll discuss the Johannesburg Security or Stock Exchange. And you should know that for every investment, there are returns, which could be in form of the dividend, interest, or capital gain. We will also get there. Now, the Johannesburg Security Exchange, it's a world-class security exchange. It connects a buyer and seller in four markets, which could be listed as equities, equity derivatives, commodity derivatives, and interest rate products. And you should understand that there are certain types of functions of the JSE. And one of the functions is that they provide companies with opportunities to raise capital through its boards, which are the main board, the African board, and the AltX. And they also provide major financial information. Basically, what JSE does is that it provides people or even companies out there with information on when shares are available for purchase, or when people can come to exchange their stock or their securities. And one thing you should know is that money in the JSE is expressed in cents, so it's not expressed in rands. That's why most of the time you're going to see maybe 20 digits, and then if you convert that to rands, you'll understand what amount you are capable of getting. So now under the JSE, you should understand that there are four types of shares, number one, preference shares, number two, ordinary shares, number three, founding shares, and lastly, the bonus shares. So for the preference shares, you should know that the the shareholder in these shares will get a fixed dividend as per the value of the shares, and preferential shareholders receive their dividend first. So you get the from the term preference, you should understand that these are shareholders that are preferred first. So in everything that happens, they consider them first. But mind you that these shares are very expensive because of the advantages that come with it. So if we were to have a company, and maybe there are few members of the company who own shares, and one of the members own the preference shares, whenever the dividend comes to life, that person will get the first pay before anyone else. That person will get the pay. So I've prepared also a case study. I want you to read it through, and then you can tell me. We're going to now differentiate between these shareholders. So the second one is the ordinary shares. These are less expensive shares, but then the trick is that they receive their dividend after the preferential shareholders. So they not much, so they're not different from what the preference shareholders. It is a fixed dividend. It's not a fixed dividend, but they receive it after the preferential shareholders. And the third one are the founding shares. These shares are for people who founded the organization, the people who established, the originators, and they receive their dividend after everyone else has been paid. And this quite makes sense because as someone who founded the organization, you want to make sure everyone is happy and everyone is satisfied before you can even satisfy yourself. It happens a lot, even from our homes, when we see that our parents after, or our mothers, after they finish cooking, they will first dish up for everyone else before themselves. So I hope this betters your understanding. So lastly, the bonus shares. These are shares awarded to, they are awarded in place of the dividend. They are combined with the original shares. So that means after you found you have your bonus shares, you will have more shares in the company and collect more dividend in future. So basically, how this is applied, like if I'm a person and I own like 15% of the shares in a company, and then at the end of the year, instead of me receiving my dividend, maybe the founders of the company would award me with an extra 10% to say, okay, for excellent duty performance, here's an extra 10%. Yes, I might not get money for that several term, for that certain term, but I'm getting shares. And combining them, I will have 25%. So that means in future, when I get dividends, I will have more money. So it's always a good thing to have bonus shares, even though you won't be getting money on that term. But on the following term, you'll be having more money. So guys, from the case study I just shown you on the screen, I want you to actually read it and then give me a list and tell me who's the founding shareholder there, who's the preference shareholder there, who's the bonus shareholder there, and I also want you to tell me how did you find the answers and why are you saying that, guys, when you comment on our on WhatsApp and ask questions. So yeah, let's move on to the second one, which is unit trust. I'm gonna explain this brief, guys. The unit trust is is a collection of funds that allows private investors to pool their money in a single fund so that you can spread the risk across a range of investments. I like this sort of investment because it allows someone with investments or maybe shares or own bonds in different geographical areas to actually put them in one trust so that he can observe them and see their success throughout. So let's make an example of someone who owns maybe who has shares in a media company that also has shares in a property company. So if that person puts those in a unit trust, they both earn dividends. So what are the risk of an investment is that you could lose out on money. That's a common risk. So what happens if a media company for that month was involved in bad publicity and no other organization associated themselves with them? What happens then? That means they're going to lose out on money. So when you lose out on your dividend in one side and then maybe your property shares, they've appreciated in value and you've earned a lot of dividend, that money you earned from the property could actually help cover the loss of the one you lost out on the media company, because it's going to create a balance between the two. So that's what I like most about the unit trust. And one thing I like is that the unit trust, it's cheap. It doesn't it doesn't require a lot of money for you to start it off. Hence is why I like it so much. So lastly, let me discuss what we call the government retail bonds. So the government retail bond, this is an investment of borrowing money to the government, and the government pays it back over a period of time on fixed interest. So now this is not you borrowing money from the government. This is the government borrowing money from you. So the government retail bond mostly happens when, let's say, someone um invest in a invest yes makes an investment in a bank, or maybe the reserve bank, and then maybe you call out for a stop order to say that, okay, I don't want to access this money until I reach 5 years. So in that 5 years, when you keep investing your money and not having access to it, the government will use that money for other uses of public service delivery. So now what happens is the government, when the government borrows that money from you, there will be a fixed interest rate. So if you borrow the government, let's say 300,000 in total, and then the interest rate the government says per month there will be interest of 5,000. So you can just count those 5,000 every month until 5 years, and then combine them with the original amount, and then that's the money you will get in the end when the government pays you back. So you could say that the government retail bond having a fixed interest is what we call simple interest, but we'll get to that when we go calculate the returns on investment. So yeah, from me that's it for now, and then I'll upload part two whereby we'll be calculating the simple interest and compound interest. Thank you.